Imagine making $20 billion.
Oh, wow.
Yeah.
Mm.
Not in a lifetime, right? Not even over the course of a decade. In 90 days.
It's just hard to even process.
It really is. I mean, you don't even have time to count that kind of money before the next quarter begins. But that is exactly the reality we're looking at today. We're taking a deep dive into the underlying machinery of global capital.
The big leagues.
Exactly. And we're doing it by tearing apart the second quarter earnings presentation that Goldman Sachs just dropped. This was released on July 14th, 2026.
Right, and it's a staggering number to try and wrap your head around, because usually when we analyze a quarterly earnings report for a massive legacy bank, we're looking for, incremental shifts.
A percent here, a percent there.
Exactly. A little efficiency found here, a slight tightening of the belt over there. But this particular release from mid-2026 is, well, it's different. It's basically a fire hose of corporate capital moving at speeds we rarely see.
Yeah, so whether you're a finance professional who models these spreadsheets for a living, or you're just someone trying to figure out where the global economy is heading based on the actions of the absolute biggest players, the data buried in this presentation is full of surprises.
It really is.
And I want to start right at the top of the mountain. In the second quarter of 2026, Goldman Sachs brought in $20.338 billion in net revenues.
Incredible.
Okay, let's unpack this. How does a single financial institution orchestrate that kind of cash generation in just 3 months?
What's fascinating here is that to reach that $20 billion mark, virtually every single cylinder in their wholesale engine had to fire perfectly.
At the exact same time.
Yes, at the exact same time. That figure represents a 39% year-over-year increase.
Wait, 39% for a legacy bank of that size?
Yeah, it's not normal. And if you look at their year-to-date total, they are sitting at over $37.5 billion.
That's just wild.
I mean, we aren't just talking about a good quarter in a standard business cycle. We're looking at a bank whose net revenues and earnings per share are approaching some of their highest levels in history.
Well, let's talk about those earnings, actually, because generating revenue is one thing, right? But actually keeping it as profit is a totally different game.
Oh, absolutely.
The net earnings alone were $6.628 billion for the quarter. That is a 78% jump from the exact same period last year.
Which is huge.
And the earnings per share, the EPS, which is, the metric that Wall Street analysts usually fixate on, it hit $20.98 for Q2.
Right.
That's an explosive 92% year-over-year increase, pushing their year-to-date EPS to $38.51.
When you see a bank nearly double its earnings per share in 12 months, you have to immediately look under the hood at their capital efficiency. Like, how well are they using the money they already have?
Right.
And the metric for that is annualized return on equity, or ROE, which in this case hit 23.5%.
Wow.
Yeah, that is a massive jump of 10.7 percentage points from the previous year. And their return on tangible equity is even higher. It's sitting at 25.5%.
I want to pause on that ROE figure for a second because it's easy for a percentage to just sound like another number.
Yeah, it gets lost in the spreadsheet.
Exactly. So if you're listening to this, think about your own money. If you put your cash in a standard high-yield savings account right now, you're probably thrilled to get a 4 or 5% yield over the course of an entire year.
If you're lucky, yeah.
Right. Goldman Sachs is generating an annualized return of 23.5% on their equity. To put that in perspective, they are taking the bank's core capital and effectively compounding it at a rate that would make a Silicon Valley venture capitalist jealous.
And management knows exactly how powerful that 23.5% ROE is. I mean, they aren't hoarding the excess cash out of fear.
No, definitely not.
The presentation notes they increased their third quarter dividend by 11%, bringing it up to $5 per common share.
Which is a huge signal.
It is. A bank only commits to hiking a dividend like that, which is, a permanent expectation from the market moving forward when they have absolute certainty in the reliability of their cash flow. It's a massive signal of confidence to their shareholders.
But that level of return doesn't just materialize out of thin air.
No.
You don't generate over $20 billion in revenue and a 23% return on equity by charging everyday people overdraft fees on their checking accounts.
Mm-hmm.
To make that much money, someone has to be doing a lot of trading and deal making, right? You have to be moving mountains of capital.
Exactly. Which means we need to look at the engine room. We need to look at the global banking and markets division.
The core of the bank.
Right. This is the historic core identity of Goldman Sachs. This one segment generated $15.52 billion in the second quarter.
Let that sink in. Out of the roughly $20 billion in total revenue, over $15.5 billion came from just the investment bankers and the traders.
It's a 53% year-over-year increase, and crucially, a 22% sequential increase just from the first quarter. Yeah. When you see a jump that large in a 3-month span, it tells you that the broader macroeconomic environment has suddenly shifted into high gear.
Here's where it's really interesting. If we break down that $15.5 billion, the investment banking fees alone hit $3.39 billion.
That's a 55% increase year-over-year.
Right. And the source material explicitly points out that this was driven by a massive surge in industry M&A volumes.
Yeah.
Mergers and acquisitions.
Yeah.
Companies are buying other companies, merging with rivals, and spinning off divisions at a breakneck pace.
And Goldman is the architect behind those moves. They secured the #1 position globally in M&A advisory. They also hit #1 in equity and equity-related offerings and leveraged lending.
And #2 in high-yield debt, right?
Exactly. They aren't just sitting in on these meetings. They are structuring the deals, finding the buyers, and navigating the incredibly complex regulatory hurdles. When a corporate board decides to pull the trigger on a $50 billion acquisition, they call Goldman.
They make the call.
Right. The fact that M&A advisory fees are up 55% indicates that corporate executives are feeling incredibly confident. You don't buy your biggest competitor if you think a recession is right around the corner.
That makes a lot of sense. And it's not just advising on mergers, they're also acting as the gatekeepers for companies that need to raise cash. Equities underwriting exploded to $985 million for the quarter.
Which is an 84% increase year-over-year.
And a 130% increase just from Q1. Plus, debt underwriting hit over $1 billion.
To understand why those numbers are so critical, you have to look at the mechanism of underwriting.
Right. How does it actually work?
Well, when a private company wants to go public and issue shares in IPO, or when a massive corporation needs to issue bonds to raise a few $1 billion for a new factory, they can't just sell them on the internet. Goldman acts as both the bouncer and the promoter. They price the shares, they assume the initial risk by buying them up, and then they sell them to their vast network of institutional investors. The fact that equities underwriting is up 130% from just last quarter means the IPO window, which can often slam shut during uncertain economic times, is currently wide open.
So they're making billions advising on mergers and billions taking companies public. But then there's the trading floor, the intermediation numbers.
Oh, yes.
Equities intermediation reached $4.157 billion, which is up 53%. And FICC, which stands for Fixed Income, Currency, and Commodities, reached $4.59 billion.
Intermediation is arguably the most complex machinery in the bank. They're essentially acting as the ultimate middleman, facilitating trades between buyers and sellers across global markets.
You know, I always think of intermediation like a massive high-speed toll booth. Goldman Sachs essentially owns the financial highway.
That's a good way to put it.
You have trillions of dollars in corporate bonds, foreign currencies, and complex derivatives driving back and forth across this highway every single second. Goldman doesn't necessarily care which direction the cars are driving. They just drop the toll booth arm and take a tiny fraction of a cent on every single transaction.
Right.
So when market volatility spikes or when client activity surges, the traffic on that highway quadruples and those fractions of a cent turn into billions of dollars.
That is a perfect analogy. And the sheer scale of the traffic on that highway is staggering. The presentation reveals that the global banking and market segment currently oversees $1.88 trillion in total assets.
Almost $2 trillion.
Yeah. The bank is deploying that massive balance sheet to ensure there is always a buyer when a client wants to sell and always a seller when a client wants to buy.
It really paints a picture of a star athlete. The Global Banking and Markets division is flashy. It's entirely driven by making the next big transaction, and when the market is hot, it prints money.
It does.
But there is an inherent flaw in that model, right? I mean, what happens when the market cools down? Don't they need something more stable? What happens when the M&A highway freezes and volatility vanishes?
Deal-making is completely cyclical. To balance out the star athlete, a bank of this size needs an anchor. They need something boring, steady, and incredibly reliable.
Which is exactly why they've spent the last decade aggressively pivoting toward managing immense pools of wealth. That brings us to their second major pillar, the asset and wealth management segment.
Right. If the trading floor is the star athlete, this segment is the steady accumulator.
And it is accumulating at an astonishing rate. This segment brought in nearly $4.6 billion in net revenues in Q2, which is a 20% year-over-year increase.
And it translates to over $1 billion in pre-tax earnings. 1.112 billion, to be exact.
But the revenue isn't even the most impressive part here. It's the scale of the assets they're controlling. Their assets under supervision, or AUS, reached a record $4.04 trillion.
Over $4 trillion under their supervision.
It's a number so big it loses its meaning.
It really does.
To give that some context, they added $391 billion to their supervised assets just since the first quarter. In 3 months, they essentially added the equivalent of a massive Fortune 500 company's entire market cap to their books.
And what you have to understand about the wealth management model is the stickiness of that capital. The presentation highlights that this marks 34 consecutive quarters of long-term fee-based net inflows.
34 quarters.
That means for 8.5 straight years, through pandemics, through inflation spikes, through interest rate hikes, more money has been coming in the door to be managed than has been leaving.
That is the anchor they need. They don't have to hunt for a new merger to get paid. They just charge a steady management fee on that $4 trillion every single day.
Precisely. And if you dig into the structural breakdown of where that money lives, it is overwhelmingly institutional.
Right, 73% of that AUS is in the Americas.
And 53% of the investment vehicles are in separate accounts, meaning bespoke, custom-built portfolios for sovereign wealth funds, pension funds, and ultra-high net worth individuals, rather than just standard public mutual funds.
The real growth engine inside that $4 trillion is what they call alts, alternative investments. This is the incredibly lucrative, highly specialized corner of finance, like private equity, private credit, real estate.
Right. They reached $44.5 billion in assets under management, specifically in alternatives, with $25.9 billion directly on their own balance sheet, largely in equity securities.
The fundraising figures for these alternative investments are wild. They raised $59 billion in gross third-party alternatives in just 3 months. They raised $31 billion for private credit alone and another $16 billion for corporate equity. Since 2019, they have raised $523 billion in this specific space.
Institutional investors in 2026 are desperately hunting for yield outside of the public stock markets. They want the higher returns that come from private credit, where Goldman essentially acts as a private bank, lending directly to companies, and they're willing to lock up their capital for years to get it.
And it is paying off handsomely for Goldman on the revenue side. Their investment-related revenues soared 222% to $441 million, fueled heavily by net gains from selling off investments in private equities.
It's a huge win for them.
But, up until this point, we've been painting a picture of sheer financial invincibility, but I was combing through the notes on this wealth management segment, and I found a pretty serious crack in the armor.
Oh, yes. The private banking numbers.
Exactly. Amidst all these billions flowing in from mega corporations and pension funds, revenues from private banking and lending actually declined by 13%. And the source specifically blames a lower net interest margin on Marcus deposits.
Marcus, of course, being the brand name for Goldman's highly publicized, deeply troubled foray into everyday consumer banking.
Right. And that little footnote about Marcus deposits segues perfectly into the one glaring, painful red flag in this entire earnings presentation, a division called Platform Solutions.
If we connect this to the bigger picture, Platform Solutions represents the consumer hangover.
That is exactly what it is. Let's look at the damage here. Platform Solutions brought in just $221 million in net revenues for Q2.
Which is a massive 46% decrease year over year.
And if you look back to the second quarter of 2025, it's a 64% collapse.
The primary cause of this revenue cratering is net markdowns related to the Apple Card loan portfolio, which, as you might recall, was transferred back in the fourth quarter of 2025.
The net earnings for this entire segment showed a loss of $43 million. And remember that massive 23.5% return on equity for the whole bank.
Yeah.
The return on average common equity for this specific consumer segment dropped to a dismal 5.8%.
It's a stark contrast.
I look at this Platform Solutions segment like a terrible side hustle.
Side hustle?
Yeah, imagine you have a highly skilled, world-renowned neurosurgeon who makes millions of dollars in the operating room. But for some reason, they decide they want to spend their weekends trying to flip houses.
Oh, I see where you're going with this.
And they just end up losing their shirt because they don't know the first thing about plumbing or drywall. Goldman Sachs is the master of the universe when it comes to managing $1.8 trillion in corporate trading assets, but they stumbled incredibly hard trying to run a standard consumer credit card.
That's actually a great way to think about it. And this raises an important question about the mechanics of risk. Why would a bank that can expertly navigate a $50 billion corporate merger fail at managing credit limits for everyday people?
Right. Why is it so hard for them?
It comes down to the underwriting models and customer acquisition. Evaluating the systemic risk of a merger between two global telecom giants requires an army of quants, lawyers, and deep industry connections, which Goldman has. But evaluating whether a guy in Ohio is going to default on his $5,000 credit card bill requires a completely different behavioral risk model. It relies on mass market consumer data, relentless customer service overhead, and entirely different regulatory scrutiny. The consumer credit environment is a completely different beast than the wholesale corporate markets.
It really is a humbling reminder that expertise in one area of finance does not automatically translate to another.
Exactly.
The presentation even notes that their provision for credit losses for this segment dropped by 100%, but only because they finally transferred the portfolio away. They are just winding down the side hustle and taking the loss.
And that lingering financial pain highlights the immense difficulty for a titan of Wall Street to successfully pivot to Main Street.
So we've explored the massive wins in the trading toll booths and the M&A advisory. We've looked at the steady multi-trillion-dollar accumulation of wealth management, and we've examined the bruised ego of their consumer credit venture.
The full spectrum.
Right. I want to pull back now and look at the actual cost of running this empire. Because generating $20 billion in revenue doesn't happen for free.
No, you have to spend an extraordinary amount of money to maintain that machinery. The operating expenses for Q2 hit $11.673 billion.
That is a 26% year-over-year increase in costs. Okay, I have to ask a pointed question here.
Go for it.
They spent almost $12 billion in 90 days just to keep the lights on and pay their people. And looking at the breakdown, compensation and benefits rose 30% to over $6 billion.
Yes, they did.
Wait, they pay themselves 30% more. Usually, if a company comes out and says their expenses jumped 26% in a single year, Wall Street punishes the stock.
Isn't a 26% jump in total expenses a bad thing for a company?
It sounds alarming until you look at the fundamental mechanics of banking. Specifically, the efficiency ratio. Remember, while expenses grew by 26%, the revenue grew by 39%.
Because the revenue grew so much faster than the costs, their year-to-date efficiency ratio actually improved, dropping down to 58.8% from 62.0% the previous year.
So in this case, a lower percentage is better. It means they're spending 58 cents to make $1, whereas last year they were spending 62 cents.
Precisely. Think of it like a bakery. If a bakery sells 100 loaves of bread one week and 10,000 loaves the next, their total spending on flour and yeast is going to skyrocket. Their expenses will look massively inflated.
Right.
But the profit margin on those 10,000 loaves makes the total expense irrelevant. In investment banking, the flour and yeast are transaction-based expenses, which rose 56% to over $3 billion.
Because they're doing more trades.
Exactly. Higher transaction expenses mean you are paying more clearing fees to exchanges, more brokerage fees, and more execution costs. Because the volume of profitable activity going through your toll booth is so incredibly high, it is the literal cost of goods sold.
That makes sense.
And regarding the 30% increase in compensation, Wall Street bonus pools are directly tied to operating performance. When the Global Banking and Markets Division pulls in 53% more revenue, the compensation formula automatically expands to reward the bankers and traders who generated it. It costs money to make money.
That makes perfect sense when you frame it as the cost of goods sold rather than overhead waste. I also noticed their tax rate was listed at 18.5%, which the presentation attributes to fewer tax benefits related to employee share-based awards.
Right.
But looking past the expenses, what about their core lending? They are still a bank, after all.
They are. Their total loans grew to $261 billion across the entire firm. But again, it's important to note where that lending is happening. $188 billion of that is held in the Global Banking and Markets Division.
So institutional.
Yes. It's corporate lending and collateralized loans to huge institutions. Platform Solutions, the consumer side, only holds $20 billion. And the net interest income, which is simply the profit they make from the interest on all these loans minus what they have to pay out to fund them, hit $3.95 billion. That's up 27% year over year, largely driven by lower funding costs.
With total assets creeping up to $2.128 trillion, How does their safety net look? Like, what happens if the market takes a sudden dive?
The metric to watch there is the standardized CET1 capital ratio. This is essentially the bank's shock absorber. It's a strict regulatory metric that ensures a bank holds enough high-quality liquid capital to weather a severe financial panic without collapsing.
And how are they doing there?
Goldman's CET1 ratio slightly increased to 12.9% from the first quarter. While it is lower than the 14.3% they maintained at the end of 2025, it remains highly robust and shows movement completely in line with their expanding asset size and market dynamics. Their overall shareholder equity is remaining incredibly stable at $123 billion.
When you lay all of these puzzle pieces out on the table, it truly is a masterclass quarter. To summarize the landscape we've explored today, Goldman Sachs is firing on all cylinders, but specifically in the areas they have historically dominated.
Exactly.
Structuring complex mergers, underwriting new equity, acting as the ultimate high-speed toll booth for fixed-income trading, and managing over $4 trillion in wealth for institutional clients.
They know their strengths.
They really do.
Yeah.
These core engines are generating historic, near-record numbers. And the sheer volume of that success in the wholesale corporate markets completely eclipses the costly, bruised retreat from their Apple Card venture.
It is a very deliberate, highly profitable return to exactly what they do best.
So what does this all mean?
Well, it leaves us with a fascinating and perhaps slightly unsettling macroeconomic observation. In the second quarter of 2026, one of the most powerful financial institutions on Earth achieved near-record profits. But they didn't do it by serving everyday consumers. They did it by catering strictly to megacorporations, sovereign wealth funds, and the ultra-wealthy, all while taking a distinct financial loss as they retreated from their consumer credit card portfolio.
It's a huge shift.
It is. If the most profitable, most efficient engines in our global economy are increasingly, deliberately disconnected from the everyday consumer, what does that mean for the long-term future of Main Street versus Wall Street?
That is a lingering thought to take away with you today. Going back to where we started, we aren't just looking at a leaky faucet of incremental change in this report, but looking at a fire hose of corporate capital moving at unprecedented speeds and reshaping the economic landscape as it does. Thank you for taking this deep dive into the sources with us, and keep exploring.